It is one of my favorite times of the month. And this is where Larry and I take a look at what Cathie said, and we try to make it easier to understand for folks who might not spend as much time on the finances as other folks. And then at the same time, we try to elaborate based on our combined experiences and what little knowledge I have and what amazing amounts of knowledge that Larry has. So Larry Goldberg, thank you for joining me on this. I guess we could call this Employment Saturday.
Employment Saturday. And let me just add a few words about Cathie. I mean, I would be remiss because we use so much of her material, not giving her a plug. And, you know, she doesn't need a plug from me, believe me. She is, I think, one of the country's leading economists.
Yeah.
She also runs, 𝐒𝐚𝐽𝐿, which is an investment portfolio of remarkable funds. These funds did very, very well up to the 2022. But because of the nature of what they invest in, which is innovation, they tend to be extremely subject to the whims, to some of the storms in the marketplace, particularly at this time.
And particularly interest rates.
Interest rates, I think we'll talk a lot about these forces that impact innovation funds, but it's my firm belief that innovation is going to be the way forward for the American economy. It's going to keep the US as one of the premier economies in the world, if not the premier economy in the world. And it will be the reason that we solve our federal budget problem. So for all those reasons, I'm a great believer in what Cathie espouses. And she is, in my humble opinion, the leading economist in the country today, apart from the leading investment lead in the economy today. So having said that, we're now going to use her work and put our own spin on it. And, honestly, there's not a lot of spin I can put on it. Randy has some perspective, I have some perspective, but what will shine through is what Cathie tells us. But I will also add this. If you want to go into depth, real depth, then listen to Cathie herself.
Sure.
Because we're going to give you a summary. We're going to give you hopefully a very understandable perspective on what she says. But I would urge you to hear what she has to say herself and follow all this work that 𝐒𝐚𝐽𝐿 does, because even if you do not invest in the funds that they manage, even if you do not invest in the companies that they analyze and they comment on, you will learn a huge amount. So,
absolutely. Yeah, well, let me add a couple of things to that. Number one is with regard to the U.S. being the leading economy. There's a few other economies in the world now that have higher GDPs, in particular the Northern European, the Baltics, have maybe
higher GDP per head of population.
Yes, per population. Yep, and Singapore, a couple of others, but those are very small, very what you want to call
unique
situations where they have homogeneous populations and they have immense natural resources.
And very small populations.
And very small populations. With the United States, we have, of course, probably the most heterogeneous population. We have massive amounts of immigration, which is a positive long-term. And we also have the 7 leading companies in the world in tech, which gives us that runway, Larry, that you're talking about. It's going to be a little hard for any other country, regardless of their size, to catch up with the U.S.
You're missing one important factor.
Okay.
we are the venture capital of the world, not by a little, not by a lot, but by a gigantic amount. It is in the United States that new inventions are put to great public use and evolve into what is the next for the global population. Sometimes not good, but most frequently and most prevalently, really good stuff. So the United States, emerging out of the 60s and 70s, the United States was such a clear leader in the world in almost every respect. And today, because largely of some of the influences of the United States and some of the technology and some of the economic innovations that the United States have introduced, a lot of the rest of the world are enjoying very similar levels of prosperity, and of course, in some of these instances, far greater prosperity. China, their great skills of engineering, great skills of manufacturing, great skills of large-scale implementation of industry are taking the lead in those areas. And that's an area where we have somewhat ceded the lead. In fact, we have been the precipitating force behind some of what has happened to China. So we have lessons to learn now from China, and we have lessons to learn from other countries as well in various areas. But China is without doubt one of the great challenges that we have in terms of where they are and where they're going. So it's against this backdrop that we should measure, the U.S. economy, where we are and where we're going. Does that make sense to you, Randy?
Absolutely. I think one of the things long-term to think about in terms of that description is that it could have been Japan, it could have been South Korea, it could have been nationalist, it could have been Taiwan. These countries did exactly what China has done prior to when China did it. Different kind of economies, different kinds of resources, different sizes of economies. China has done what those three countries did very well in terms of taking over the manufacturing for the world. And now what I think we need to watch out for, which I would love to have Cathie speak to, maybe you can bring it up to her some Friday morning, Larry, is China just is investing, I think they said $50 billion more into Africa. There's going to need to be another country now. There's going to need to be a inexpensive labor resource. Mexico could be part of that, some of the South American area, and China's making big investments in South America and Mexico as well. So the United States might fall behind as they continue to use China as their primary resource rather than looking for these new inexpensive labor place. Now, if we replace all that with robots, throw out everything I just said.
That was where I was going to go. That was where I was going to go. We need to leapfrog this notion of, inexpensive labor. And I think China's gone far beyond inexpensive labor. What they've gone to is, this industrialization with enormous productivity. I think that, who was it? I think it was the CEO of Apple, Tim
Cook?
Tim Cook.
Yeah, I know.
Tim Cook, the CEO of Apple, gave a recent interview about China and about why they go to China to manufacture. And it isn't because of cheap labor. On the contrary, it is because of the industriousness, the extreme mechanization, the extreme productivity, and the scope, that is to say, just the ability to scale incredibly large. And so China's no longer hasn't been for some time about cheap labor. China's been about their industrial genius. We, by the way, can learn a lot from China. And I will say to you that there's nobody who has done more in that respect in the United States. And there's no one even close who's done more than that in the United States than Elon Musk in terms of returning manufacturing to the United States. I would not say it's the General Motors and the Fords of this world. All right, so let's go back to the theme of Cathie's in the know, and let's learn about what she has to teach us. And believe me, she has a lot to teach us. Can you see my screen? Is it
good? All good. Yep.
Good. And I do want to. Oh, there we go. All right, so this is Cathie Wood, Cathie Wood's September 7, 2024. And what's nice about what she's doing now is she's starting in the know, instead of going straight into the economics and the slides and the current economic environment, she's doing some thematic introductions of what they do at ARC. And so what they talked about, she had two guests on this week, and we'll introduce them in a second. But what she wanted to talk about was AI, the stage that it's in, and will it become highly profitable? Will it become commoditized due to massive capital influx? Everybody's in AI today. There are billions and billions rolling into it. And there's an open question as whether we've reached peak AI, whether we've reached peak investment, whether all this investment is going to be for naught, whether it's going to be wasted, or are we in this moment of change into a new world? And so the early results, Cathie says, is that we're at the beginning of a transformative technology journey. And this has been presaged by ARC for many years. I mean, I became aware of ARC back in 2017 or 20, yeah, in around that period. And Cathie was already preaching this message. And I think it's happening as fast and maybe even faster than Cathie had in mind as she set up ARC and based her entire thesis on innovation. So she introduced two of her senior people, Joseph and Joseph talked about the AI market. And Joseph's thesis was that we're in the 90s in the internet era as far as AI is concerned. And there's going to be a significant economic disruption.
Cathie suggested we might not even be in the 90s yet, by comparison, that we might be in the late 80s by comparison in terms of where the I don't know, how would you call it, the move from the science to the infrastructure to the apps to the et cetera, that we might even be in the late 80s as a comparison.
Yeah, I honestly don't believe that the trajectory of this revolution is going to be anything like the trajectory of the internet revolution. I mean, you know, all revolutions are different in character, like recessions and like unhappy families. So I don't like to say, I think it's a good way to kind of orient people to the fact that this is an early stage, and orient people that the fact that it's going to make a major change. I think those are the parallels. trying to pin down, this is when that happened and now we're kind of happening at that. I don't think that's apt. But nonetheless, there's this debate about whether AI will be highly profitable and some people are saying, oh, it's just going to be commoditized. Everybody's going to have AI and it's just going to be commoditized and nobody's going to make money out of it. That's kind of like they said about the internet, and that was kind of like the battle between Netscape and Microsoft. And it turned out the battle for the browser was a side issue, was actually a non-issue. And it came to the point that the browser doesn't actually mean anything. In fact, we're about to enter an age where we don't even use browsers anymore.
Right.
So we worry about the wrong things at the time that we're worrying about the things.
Of course.
So I don't think that there's going to be commoditization. There's going to be a lot of specialization. There's going to be a lot of new emergent ideas, emergent products that we cannot even at this point imagine.
Absolutely.
And companies like NVIDIA, says Joseph, are early indicators of how AI will impact industries, and early results show that we are at the beginning of a transformative technology journey. And that really sums it up so nicely. So as far as the market is concerned, watch this space. So Nick, he's really focusing on the consumer aspect of this. And so how does this affect the guy in the street who's buying stuff and who's using stuff? It's different for everybody. And, I'm talking to Randy. Randy finds a PC to be, a good tool, but nothing he wants to spend his life digging into, compared to some of the, youngsters today who see this as kind of their basis of life.
Yeah.
So you have this gigantic gap between one another. But from a consumer point of view, Nick is telling us that AI presents a significant consumer opportunity by offering person assistant-like tools for personalized service and product recommendations. I think AI is a step above that, even from a personal point of view. And you only have to look at Neuralink to understand what AI can really do.
Yes.
Neuralink is an AI product.
Sure.
Yeah, it's a physical product. Yeah, it's a, an ingenious implementation of robotic surgery. Yeah, it's incredible engineering to be able to put these, hair-like, thinner than hair, actually, probes into the brain, even, just into the cortex. But that's not the brilliance of it. That's not the genius of it. In fact, in the very first patient, they lost a lot of the probes that pulled out due to, various surgical aspects of how they went about the first patient. And they were left with very few, just a handful, really. I don't remember the count, but maybe 16 probes out of the 256 they had planned, or I don't remember the numbers offhand. But here's the magic. They were able to use AI that instead of one neuron in the probe talking to one neuron in the brain, they were able to use AI to generate the general pattern that was coming from neurons in the general area and interpret that.
And get phenomenal results from far fewer probes. Yeah.
Yeah, and get, better results than any other method has got in the past. So,
And Larry, let me give another one. This morning, Brian Wang and I put up a video. It's going to be widely distributed too. We're going to distribute this a lot because people just aren't really recognizing what the amazing potential is for automated trucking.
yes.
And so you get AI involved in your trucking, as we know is going to happen. And we have now seen the semi-trucks from Tesla with their gear out there, getting the FSD ready for the semi-trucks. But Brian estimates that it will save 90% of the trucking cost on any kind of semi-truck delivery. Well, that doesn't just impact the freight from the manufacturer to the distributor, or the distributor to the retailer, or from the port to the distributor. It also impacts the freight from the farmer to the manufacturer, or from the miner to the manufacturer. So you're impacting the cost of goods at every level throughout the system. And he thinks it's going to end up being like maybe a 10 or 15% reduction in the cost of all products just because of the reduction in freight.
Yeah, I think he's absolutely on target. And then there's the second order effects. What about the improvement to the roads? I mean, the quality of the driving, the autonomous driving is going to go up. We're not going to get impatient drivers. We're not going to get, speeding truck. We're going to get trucks that obey the laws and that open up the lanes for the non-truck lanes, and the opportunity to platoon the trucks, at night, for example. I mean, the opportunities are just huge, and that's just one second order effect. The second order effects are enormous. I mean, apart from the climate impact, the CO2 emission drop and so on and so forth. So he's not wrong. I mean, I did an analysis on trucking some years ago now, just on the Tesla truck specifically, and on the use case that they're at. And even, just in that narrow use and without the autonomy aspects that Brian is so focused on, the potential economic value is just enormous.
Yes, yes.
Yeah. But yeah, I mean, so innovation, is going to be very significant for the consumer. Advertising will likely integrate with AI services. With AI-enabled advertising to reach 600 billion, that to me is a big disadvantage. I think advertising should be banned. AI agents could drive e-commerce, facilitating $9 trillion worth of transactions by 2030, acting on behalf of consumers. The value captured by AI-driven services in both advertising and e-commerce could raise from 600 billion to 800 billion. That's not small change.
No.
And a debate, I want to pick up my laser pointer. A debate exists over who will capture this. Well, my laser pointer is not behaving.
Okay.
A debate exists about who will capture this value, with incumbents like Apple and Microsoft facing competition from faster moving startups. So, Microsoft survived, and as did Apple, and prospered with the internet transition. But Google was created during that period of time.
Right.
So we will see the landscape shift and change and evolve.
Mm-hmm.
And names that we haven't heard of yet will become, commonplace, and will become household names. So, I mean, there is a lot to learn from this transition. And this really is thematic about how Cathie thinks about the economy in the coming years, because she thinks that AI and other innovations that they focus on are going to make a significant difference to the economy, whereas in the classical world that we were in, we would be heading for a very difficult time. And she thinks that this revolution, that this particular innovation and the others that they focus on, will actually exacerbate that, will solve that problem, and will lead us to a better economy. And that, I think, is very thematic in what she teaches us.
Yeah, in fact, I think she says, and others agree with her, that we could be looking at, instead of maybe a 2.5% GDP growth per year, we could be looking at 10% GDP growth per year. which would
Yeah, and that harkens back to what we talked about earlier about the US economy.
Right.
And one of the fascinating features of the US economy is its ability to revolutionize itself.
Yeah.
And that's true, by the way, of the American political scene. We may be seeing such a revolution happening right now. I don't know how it'll evolve, but if you go back through, our history, back to our founding, in fact, before our founding, you'll find that America reinvents itself very frequently, and we're in that moment of reinvention. So now to the economy, and Cathie talks about the statistics from last month. And so retail sales saw an unexpected burst, even as income growth remained slow, with the savings rate collapsing. Such a strange set of circumstances. But clearly the savings rate is collapsing as people are spend and because income growth is remaining slow.
Now, I think this also, she didn't break it down, but I believe that the retail increase was ex auto. So auto.
Yes, she does talk about auto sales disappointing.
Right.
Yeah. Yeah.
So this retail sales was mainly online, a little bit in Nordstrom's, definitely not in places like the home centers. So it's a lot of folks buying their staples, paying more for their staples, of course, and not in durables, not in auto. So this is also kind of again, as you've pointed out, Larry, an economy which has got a lot of wrinkles in it in terms of what is succeeding and what is shrinking.
Yeah. So she thinks that inventory drawdowns are happening and retailers are aggressively pricing to clear stock. That's interesting because Christmas is coming, right?
Yeah, you usually, I mean, the orders are being placed right now, but the first shipments, usually come in about November 1st.
Would orders be placed now, or would orders have been placed in the
Well,
summer?
it depends on what you're talking about. So if you're
Okay.
talking about what do you call it? The major mass marketers, no, we get those orders in like April.
Right.
Yeah, but the local small business owners,
Right.
They place their orders now. They start getting them around the 1st of November.
Yeah. And new home sales rose sharply. I mean, a 10% rise in new home sales, that's extraordinary. I mean, that is extraordinary in 1 month.
Yeah, but it is a single data point, as she points out.
Yeah. But other housing metrics remain weak, with existing home sales hindered by low mortgage rates, locking people into their homes. That's been going on for a long time now, but that may be changing now. That may be changing quite quickly. Industrial production and auto sales weak, signaling further production cutbacks. So, yep, people are on their last splurge, as they say. By the way, that augurs bad for Christmas, doesn't it?
It does. It does. And that is, I forget the number now. I want to say it's a third. The Christmas purchase is a third of the retail year, something like that.
Yeah. So, and then, of course, the non-farm payroll reports show weaker than expected job creation, with job openings falling significantly. Despite this, the unemployment rate held steady at 4.2% and wages rose slightly.
They didn't raise slightly. What they rose 4.8, 0.4% for the month, which is 4.8 annualized. And even the annual figure, I think, was 3.7. So both of these numbers are actually high and should be sending shudders through the Fed. She said, she goes on to go into this is one place where I didn't agree with her. She goes on to say the Fed should be feeling good about what they're seeing in the labor numbers because they're not necessarily dry. That I guess it was in terms of productivity, which maybe we'll talk about later, Larry. But she's saying that the employees are producing more, so the ultimate labor cost that's moving into the economy shouldn't be worrying the Fed. The Fed should be happy with that.
Yeah,
But the
but
labor
because of
going,
rising productivity.
right, but the labor number going up this much is, I think, still a concern, quite frankly.
Yeah. I mean, household employment data, more reliable than non-farm payroll, suggest much weaker job growth. I think that's the point.
And you and I spent a lot of time on that last night. If people want to go
I know.
back, take a look at that video from last night, I'll put that card up at the end also.
So on productivity and unit labor costs, she said productivity has grown faster than expected, with unit labor costs remaining low, signaling the labor market is not pushing inflation as the Fed feared. This is pretty thematic for what she said for some time now, but the labor market is not the source of inflation, is what she's saying. Rising productivity and stagnating wage growth suggest that companies are investing in technologies to improve efficiency as they lose pricing power.
Yeah, and here's, I've talked about this a lot on this channel, Larry, and with you, but it's one of the areas where I spend a lot of my time really digging into the weeds. And I was surprised that productivity didn't pick up even faster. And I think we're seeing productivity picking up faster now because of what I was talking about a year ago. And that is, these companies now are getting way more strategic in their job decisions. They were just hiring anybody they could and bulking up their workforce because there was no employees out there. And you also had a lot of turnover in those employees where they were going after that next better job in some of the company. And people were quitting that, you know, what they call the silent quitting or something like that. So you had a lot of churn, and you had a lot of costs of getting those employees up to speed. Now you're getting that result where now people are saying, oh, no, I'm not leaving my company. I don't see a lot of jobs out there. So they're getting more efficient. The companies are starting to let people attrition out rather than adding more labor as their workforce gets smaller. And all of that should be adding dramatically to productivity, in addition to what we might get from AI and from better productivity methods as companies start to concentrate on automation again, rather than just getting it out the door, which was what they had to do for a couple of years.
Yeah, I'm inclined to agree that productivity improvements are coming yet still from exogenous functions such as you've just pointed to. I don't think we're seeing productivity coming yet from AI. I think those days are yet to come, and I think they'll come in, in large numbers later in this decade. And then
just real quick, some of those AI opportunities will come later in the decade. Some of them, the ones that you and I care about the most, are going to be coming next year and in 2026, as we have robotaxis and semi-trucks and automated semi-trucks and robots and stuff.
No, but I have to disagree with you.
Okay.
All of those innovations will come next year. I agree with you. Next year and the following year, I agree with you. But the productivity gains from them will not come next year and the following year. You have to get a very large percentage penetration into the market before productivity really registers. And sometimes there's a negative impact as they come into the marketplace. So you're not going to get it in year one, and you may not even get it in year two. It's, in that subsequent year that you really begin to feel it. So while we talked about, the internet in the late 80s and, early 90s, it really took time for that to actually evolve and become, an impact on the bottom line. So yeah, they're coming, and they're coming really quickly, but the impact on the bottom line sometimes is negative before it becomes positive, and before it becomes, enormously positive. Does that make sense?
Yeah, I think I'm halfway in between. I think that I look at everything in the economy is on the margin to me. If you can pick up even from 2.8 or whatever or 3.0, whatever the GDP was, if you can pick up another if you can make that 3.4, it has a.
Oh my, well, that's gigantic.
Right.
You see, I
So-
think this is the gap between you and I.
Yeah.
I think that the first impacts are negative
Mhm.
at a very small percentage, 0.001, 0.002, all the way up to 0.01, until they start becoming positive, and they start becoming positive at 0.01, and then get to 0.02. A jump from 3.0 to 3.1 is a gigantic jump. Just to put it into numbers, it's 0.1% of $10 trillion. Well, it sounds like a lot of money, but it doesn't change the rounding of, in 10 trillion. Make sense?
It does. It does.
Okay. So Cathie then talks about confusion in the equity market. She says the equity market is confused. Boy, is it confused. I mean, when you get a stock swinging 20 points in either, a stock of $200 swinging 20 points in either direction in 2 consecutive days, this means confusion. Because conflicting signals of economic growth, productivity, inflation. Companies are investing in productivity gains, but a lack of pricing power and potential job losses loom. Okay?
Oh yeah, no, I mean, you and I have been saying it for a while now, but I think our prognostications are coming true as she's reporting, as we're reporting. And yes, it has been, I've said it so many times. I think it's one of the most confusing times. I mean, an economy like the United States or the world has so many moving parts, it's really hard to analyze anyway. But when you've got inflation numbers still sitting up technically in the rearview mirror, but at almost 3%, but you've got pricing power being lost, and you've got people cutting back, manufacturers cutting back, and you've got auto down, and you've got housing down for 2 years, transportation down or trucking down for 2 years, manufacturing horrible for over 2 years.
Auto sales down.
Yes, you've got all these moving parts. It's kind of like trying to understand the weather from cloud patterns. There's just so much more to it than you need AI to figure it out, Larry.
The thing about cloud patterns is we now have satellites that look from above.
That's right.
We don't have a satellite for our economy yet.
Yeah, that's right.
So on to the graphs. Cathie shows these graphs every month, and we see the progression, and we hear what she analyzes and what she has to say to us about them, and gives us a sense of where we are. This is our satellite view. And she says the federal deficit remains above 5% of nominal GDP, despite gridlock in Washington. I mean, this can't go on much longer. It just can't.
We are going to get some help. And well, we're already getting a little bit of help from the treasuries being down from 5 to 3.7. If the treasuries continue down to 3.25 and down to 2.75, we'll get some more help. So that's going to help the deficit, even as the government continues to be profligate in spending.
I think the government will eat up that deficit by hiring more people.
Right.
They'll take care of it. They're very, they really work hard at that kind of important gap to fill. I hope our listeners really understand that I'm being a little facetious.
Well, if we do she did point out, if we do go into an actual recession, there will be some increased government spending because of the social safety nets that have to be fed. So there is a little offset to that, but I guess I'm looking out 6 months where the economy starts picking up again, and we're down to maybe treasuries, 10-year treasuries being in the threes, in the low threes. Yep.
Economic growth and new technology adoption may help reduce the deficit in the long term. And that, of course, is that's her theme tune. And that's really what we should really hope for. And then she mentions Elon Musk's focus on government efficiency could be a potential example of how technology may streamline public services. Yeah, I hark back to my cry about how Reagan, really cut a huge amount of government regulation. And I think that could be an important unleashing of the private private enterprise and employment. And I think people would be a lot more innovative without some of that leashing. So, without getting into that in great detail, I think that there are ways and means to tackle this federal deficit. And it's so important that we get, back down to reasonable levels. I think about the 2000s, that one time we climbed above zero in my in my adult lifetime. Actually since Nixon. It was that one shining moment, and again, all the events colluded to make that happen.
Right.
So, moving on. Money supply and inflation. And of course, this is a complicated slide to explain, but basically, M2 money supply has again turned positive, but remains historically low. Here's the historic level for money supply, signaling potential deflation in the near future. And by the way, velocity of money, which is very seldom discussed, and I don't know why, is still extremely low.
Right.
The CPI, that's on the left-hand scale here, is probably going to move into the 1% to 2% range. So the cost price, the consumer price index is not high. I mean, it's actually going to move into this very, very good range of 2% and probably go negative, as we did in 2020, as we did in 2014 and 2015. Why? Because we're functionally in a recession. And so the Fed will likely be easing aggressively soon. Not soon enough, and probably not aggressively enough. But we think that they're going to move. And as always, we'll be looking back and say, the Fed acted too late and too little, after acting too much and too soon.
No, too much and too late and too much.
Too late. Yeah, I'm sorry, you're right. It wasn't too soon. It was much too late. Much too late. I think they talked about transitory inflation.
And I have to say it again. They were right that the inflation problem was transitory until the current administration ladled on all that additional stimulus.
Yes,
and that it could have worked itself out with that additional stimulus.
Yep. But they should have seen that additional stimulus was coming.
They should have.
Be interesting to see. I guess Cathie wasn't doing these commentaries at that time. She only started. Yeah, or was she? Actually, she was, if I recall. Be interesting to go back and look at her comments on the turn that the Federal Reserve took. I'm going to do that actually one of these days. The yield curve. So the yield curve is your favorite hobby horse?
One of. Productivity is my number one.
Okay. So why don't you talk to the slide? I'm getting dry of mouth here.
Okay. So what we have, of course, we talk about it every morning and every night on my show. And what we have here is the yield curve, which has been inverted for the longest period ever, and very deeply inverted.
Just to explain what the yield curve means. Do you want to just explain what the yield curve means?
Yeah, you have here the difference between the 10-year should typically be have a interest rate higher than the 2-year.
And the reason for that is very easy to understand. You've got much higher risk if you have to wait for your money for 10 years rather than for 2 years. So classically, and as long as the law of economics applied, a longer term debt has a higher interest rate than a shorter term debt.
Right. But because we have the Treasury and the Fed getting involved in, how this all happens with the Treasury bonds and other aspects of how they work, sometimes you can get in this inverted situation. People have claimed that if you get into an inverted situation, and this was deeply inverted, and for 24 months, you have you're setting yourself up for recession. And Larry, you can use your cursor to show where each time that the re-inversion started, we went into recession. So it was inverted for a period, and when it re-inverted into the right way, into the proper alignment, then that's where the recession started. So we've just this last week, are finally firmly, it looks like, 3 basis points lower interest rate for the 10 than for the 2 years. So
yeah, so each of these gray areas that I've highlighted are a recession, and you'll notice that each time they happened, it was after we came out of this inversion. Of course, this horrendous period in the 70s,
right,
going into the 80s, when Paul Volcker forced the country into recession to end this craziness that we entered into in the 70s. As we exited that inversion, so we had this recession, a very big recession, and then multiple recessions thereafter.
And Larry, not investment advice, but if you look at this chart, the 2-year should be a heck of a buy right now.
Yep. Yeah, so I'm a beneficiary. I have a lot of cash. I've had a lot of cash over these past several years, and because I'm very, very, very conservative very conservative with my allocation of money, but therefore when I invest in stocks, I invest in crazy, very speculative stocks. But I keep the bulk of my money in treasuries, and treasuries, the short-term treasuries have been very, very good to me, and the long-term treasuries have been a great investment because, if having bought them, in the time that they were relatively high, as the interest rates dropped, so the value of the treasuries have gone up. So it's been a very good period for people who were liquid at that time, which I fortunately was.
Yeah.
So now we see that the inversion has come to an end, and so we're functionally in a recession. And Randy and I have been saying that for some time. I think Cathie's of the same mind. Sometimes we've had differences of opinion with Cathie, but essentially we've been thematically aligned with her. And what she says is that we're probably nearing the end of the recession. We probably have been in a recession for a time. She calls it a rolling recession because it's affected very badly several aspects of our economy, particularly housing, and in particular areas of industry, but not everybody equally. Every recession, as I've said often, is different. But recessions are relatively short. They're painful, particularly painful those people who have been hurt by them. And then as we come out of it, the emergence from that recession is also very different from recession to recession.
And I want to also encourage people, again, as I have so frequently, pay attention to the demographics. I started telling my grandchildren and anybody that listened to me 10, 15 years ago, get into the medical field, in particular with regard to geriatric care.
Yeah.
So one part of the economy that's not going to be in recession ever, or at least not for decades, is going to be medical. So right now, that is the star of all technology and medical are the 2 big stars in terms of where there's no recession, and probably not going to be looking at one.
Yeah, well, we could do a whole show about that particular subject. It's an interesting subject because, you know, there are real problems in our healthcare industry, real problems of a very serious nature, and it bears examining. But moving on, we look at non-farm versus household employment levels. So we see that it's still positive. Non-farm payroll employment levels year over year percentage change. We see that we're still positive. We're above zero. This is zero line. We're above zero. And it says not, and the graph is telling us that non-farm payroll, the heavy dark line, shows growth. It's above zero. But household employment data, that's the lighter line, typically more reliable, and we're going to talk about reliability in a minute, indicates zero growth, aligning more with recessionary conditions. It's not negative yet, but it's zero growth, and it's fallen precipitously in the last, I don't know, the last year or so, within the last.
And Larry, I should have brought it up. I should have given you a slide or something on it. I just saw a headline this morning in X, and it was from the Labor Department. In the last 12 months, we've gained 1 million jobs, part-time jobs, and lost 1 million full-time jobs. So this is kind of where we've sit over a 12-month period.
Yeah, that's very sobering, isn't it?
Yeah.
Of course, part-time jobs, I don't know what the definition of part-time jobs is. It could be a reflection of the gig economy. Yep. We don't know, but yeah, it's very, very big and very interesting change in the makeup of our economy. And then Cathie looks at the preliminary employment revisions each year. Oh my word. I mean, look at it. I mean, recent employment data have been significantly revised downwards. The last time this happened was in when? 2009. Does everybody remember the recession in 2010? Yep. So recent employment data has been significantly revised downward, indicating a much weaker job creation than initially reported. And what else does it indicate? It indicates a terrible weakness in how we collect the data. And a lot more could be said on that subject. I'll not bore our people, and we go, you know,
we could go very deeply into the weeds.
Yes, we're banging on again, you know, a lot too long, but you'll see that the last time we experienced this indicator, this is I call it an indicator. No, it's not really an indicator. This is just data of how bad our employment data is, that we have to have these revisions, you know, and we have to revise it up and then revise it all the way down again. It's really bad.
But Larry, and I don't want to, again, go too deep into the weeds, but I have seen a couple of people that really do go into the weeds on this say that when we see these consistent month after month after month downward revisions, that is actually a recessionary indicator.
Yeah.
Because it takes them longer to get the data when you have unemployment going up.
Yeah, and perhaps we should help everybody understand that recessions are always announced after the recession.
Right.
We aren't, you know, the people who define recessions has become such a political issue that the people who define recessions don't define them until well after the fact.
Right.
Now, they could argue it takes time to gather the information and then do the analysis of the information, blah, blah, blah. But the reality is that it is so politically sensitive that it's easier to say, oh, well, back 2 years ago or back a year ago, it's actually typically a year ago, 9 months a year, back 9 months or back a year, we had a recession. Right. But guys, it's over now. And, you know, the current administration or the current thing is okay.
Yeah.
So, yeah. So, but, you know, probably a more important measure is job openings. So that's called the so-called JOLTS report. And you'll see job openings have decreased sharply, suggesting companies are freezing hiring rather than laying off workers in large numbers. And why are they freezing rather than laying off? Because they had a really bad experience coming out of the pandemic, when they couldn't hire for love nor money, and they're very reluctant to let go of people, and particularly people that are in full-time employment
And
rather than in temporary employment.
And particularly skilled workers, because skilled workers are still in short supply.
Right. And then we get to, I think, the most telling number of all this week and this last few months, and that is US personal savings rate. Look at the last time our savings rate got down to these levels.
Mm-hmm.
It was about 2009, 2010. Do you all remember what happened in 2009, 2010? It's become a theme.
Mm-hmm.
Tune. I could write a song to it. I mean, yeah. So you'll see that when we get down to those levels, we tend to have recessions. Not always. It's not a consistent marker. We've had recessions where we're not down as far as that level, but getting down to that level is really indicating that people have run out of money. People have run out of their savings. They're down to their last, few percent of their savings. Those people who don't have savings are offset by those who do, and those who do seem to have lost a very large proportion of their savings. So, the rate will rise if job losses increase, and it'll reduce consumption even further.
This is the ratchet effect, or the flywheel effect. You've got the consumer runs out of money, stops buying, companies lay off. Therefore, you have less money in the economy. So it flywheels. And
there may be a step in that progression that you left out. The consumer runs out of money, borrows money.
Yeah. Can't pay.
Which is kind of which kind of adds to the braking effect. So yeah. Non-farm productivity, output per hour, it's been rising. Yep. Look at that. Yep. Pretty nicely, helping keep unit labor costs low despite wage increases. So that's a good thing. That's a very good thing. And non-farm unit labor costs dropped like a stone. Mm-hmm. And so industry unit labor costs have remained near zero, below pre-COVID levels, indicating little inflationary pressure from wages despite the union gains. And, union gains, I think, are now marginal to the economy because it's not a very large percentage, I don't think. But somebody's going to tell me I'm wrong.
I think she said 10%. I think it's 8%. Last time I heard it's 8% as unionized.
Yeah.
A lot of those unionized workers are not in the private sector. They're teachers and government employees.
That's right. Yep. That's a very astute observation. So Bloomberg CPI. So the Bloomberg Commodity Index, that's the price. That's the price of all major commodities, with energy prices in particular moving lower, has really been a tax cut for consumers and business. So that's, that's a very positive thing. Notice during the pandemic, it went negative.
Yep.
And then this is a favorite slide of Cathie's, the metals and gold ratio versus the 10-year Treasury yield. So Treasury yields, which have followed really the metals, the price of gold, the metals and gold ratio versus the US Treasury yield have remained surprisingly consistent since 2004, and actually even earlier, because they really aligned sometime. They aligned in movement back in 1980, but by 2000, those lines had actually fused and remained amazingly consistent with each other. And now look at how they've parted. Yeah. So what Cathie's saying, Treasury yields remain too high relative to the inflation expectations, because this is, after all, what is likely to be the inflation that is coming down the pike, or at least the market sees, is the inflation coming down the pike. And Treasury yields are not, have not followed that course. So So what Cathie is saying is the Fed is not just restrictive, which is what Chairman Powell is calling monetary policy. It's very restrictive.
Right.
But, and we should underline maybe that very restrictive. And venture capital industry, which is the industry I'm in, are really hurting badly because of a disadvantaged situation. They don't have cash. They're all running out of cash.
Right.
And guess what? They can't raise more cash.
Right.
And some extremely promising technologies are losing, traction because they don't have the means to actually pursue it. Now, in some respects, it's a good thing. It's a little bit of discipline being applied. Well, it's a lot of discipline being applied all of a sudden to a very undisciplined market that had got a little frothy, got very frothy. So in a way, it's a good thing, but it's really hurting innovation quite badly. But Cathie says, with a lot of emphasis, I think that's about to change dramatically. She sees that, money will come back into the market. The Fed will open up the stopper a little bit. People will be less inclined to sit on the sidelines. There's supposedly a huge amount of money on the sidelines in private hands. And why would they be in the sidelines?
Can't find a better deal.
That's the point. There's no better investment than government bonds. Well, there hasn't been a better investment than government bonds up to in the last year and a half.
Yeah.
So the bond market is not reflecting deflationary risks as the high yield spread remains narrow. The high yield spread, the spread between that Randy talked about, remains narrow despite rising bankruptcies in real estate and private equity.
Well, some less. Well, I don't want to say it that way. When you are a sophisticated investor, you're not only looking at what you can theoretically get from your investment this year or next year or the following year. I mean, you're looking at it over several years, but you're also looking at what the risk is associated with that income over that time. And so if you're looking at commercial buildings, or if you're looking at a manufacturing company, or you're looking at a medical company, these all have different risks associated with them. Right. And Cathie's in this riskiest business, and Larry, you're in this riskiest business. You're hoping that 1 out of 20 of your deals goes to the moon, and then the other 19 can go broke. Well, when you're in that kind of a risk environment, banks are loath to put money out at prime or prime +2 or prime +4. They want prime +9 in those situations. I know, I paid that much.
Yeah, and the industries we're in, they want nothing. They don't want
nothing. They don't want it at all.
Yeah, they don't want to lend money into the markets that we're in. And, that remains the markets in which private investors are traditionally in. And some funds that are prepared to take that risk. But right now, they're not putting that money at risk because they, like me, like Cathie, are expecting, the world to turn, right, and are not going to deploy that money until the world turns because we're doing so well out of bonds.
Right.
Yeah, so a drop in interest rates should alleviate the cash burn concerns for companies, leading to a more favorable environment for equities.
Right.
Out of Cathie's mouth into God's ears.
Right.
So, then she kind of she concludes by saying, despite confusion in the markets, there are opportunities ahead in the form of deflationary, technology-driven growth. The deflation associated with technology cost declines will lead to booms in growth and job creation, particularly those who embrace technologies like AI. Guys, you heard it here. And if you're not paying attention, now's the time. Innovation tends to gain traction during recessions, and AI adoption is expected to rise significantly in the coming years. And that's why I believe that some of the investments I've made in the last 2 years are going to be some of my best performing investments.
Mm-hmm.
Because they've been made in a time of such bad environment that nobody else was prepared to invest. If I've chosen well, I think I'll do well. If I've chosen badly, then as always in this industry, I lose it all.
And then, of course, we come all the way back to Tesla, which is, you know, what the channel is all about. And Tesla, of course, you almost can't think of how you could be better positioned.
Thank
What
you.
you want to have when you're going into a recession, you want to have new products and new technologies and things that consumers want that they're willing to pay for even in a recession. Tesla's got an entire list of new products coming out over the next 6 months that are going to be hitting the market that are extremely high potential sales lines. They have a cash in the bank, 30 billion, so they don't have to borrow. And then as these interest rates comes down, it makes the products that they're selling more affordable, and it makes the amount of the percentage that you use to determine the valuation of the corporation more positive, which should increase the value of the stock as well.
Yeah, so Tesla is really an assembly of innovations, of innovative products. The electric car was their first innovative product. I think we're going to see many more arise out of it. You know, the Mega Pack, the Powerwall, these two. I mean, the one that doesn't seem to have got any traction yet is the solar roof. Who knows what's going to happen with that? But certainly the Powerwall and the Mega Pack, Autobidder. I called the Mega Pack a robot yesterday.
Yeah.
And why did I call it a robot? Is because it's a huge battery with electronics, with smart electronics, and it's got a brain. Mega Pack. So there it is. It's a mechanical device, an electromechanical device that is driven by AI. And so that is an amazing, innovation. And then you have coming down the pike, autonomous driving, and coming down the pike, the robot Optimus, and coming down the pike, is AI, fully embodied AI. And we've embodied it in the battery, we've embodied it in the car, we've embodied it in the robot. And it'll be interesting to see where we embody it next. And then if you expand beyond Tesla to the Musk companies, you see the same thing happening in SpaceX, in Neuralink, in the Boring Company. And so,
xAI, of course.
and of course, xAI is kind of the laboratory for all of this. So, it's a pretty exciting period of time. And I think what I will like to close and say is that in my experience, there's no better time to invest in a business than in a recession. Yeah. And this recession is no exception.
Right. Okay. All right, Larry, I'm so happy to have you along helping me chronicle this crazy period of time that we're in and the amazing adventures of Elon Musk and the Tesla company. We want to remind people of those two videos that I mentioned earlier. One would be the Brian Wang video where we talk about the semi-truck. There's trillions of dollars of potential there. I want you to watch that video. I'll put that one up. And then Larry and my video from last night where we went much more in depth with regard to what happened with those labor numbers yesterday. So both of those will be up above. You had your parting shot already, Larry, but I'll give you one more if you need it.
Have a great weekend.
All right. You as well. Thank you so much. And to all of you out there, it's been great talking to you.